Hello and welcome to our viewers and listeners out there. Welcome to your valued CPA. Please note that any information provided on this podcast, make sure you run it by your tax professionals and your trusted advisors. And nothing that I'm giving you is your specific tax advice. It's conversations about situations that I have come across over my career and things that are noteworthy for your discussions, for your knowledge, and always, always, always consult your individual tax advisor to make sure what does and does not apply to your specific situation. Over the last several weeks, I've done quite a few Ponzi scheme podcasts, and the more and more and more I dig into the victims of the situation, the more I uncover and the more I want to share with you. So you can find some details in previous podcasts. And today, what I want to focus on is shedding more light into the hope that can be provided in the situation. And I'm doing this because it's such a grim scenario when one loses your entire investment and is actually unsure whether you're going to be able to recover anything through receiverships or lawsuits or from wherever, whatever sources. However, there are things one can do in a specific situation. And in this situation, it's how to record your Ponzi scheme losses correctly and appropriately to be able to maximize that deduction legally and see what other tax planning opportunities or options you may have in the current year of discovery or in future years once you may potentially have to record any recoveries received or look at any clawbacks that the IRS has to do. So, super valuable for those that have been impacted by the situation. And for those that have not been impacted by the situation, hopefully you never will. And hopefully you never come across anyone who would be impacted by this. But do know that there's things that can potentially be done. And I look forward to sharing them with you. All right. So, with this episode, I want to go into some advanced tax planning strategies for Ponzi scheme losses. We're going to focus on the current year of discovery, and we're going to focus on future years. And just to let those who know me, I'm a glass half full individual. So I always want to find the silver lining in whatever tax situation I'm in, or whatever business situation I'm in, or whatever life situation I'm in. And well, that's what I'm going to say. That's exactly what I want to make sure is happening for you so that your mind can start processing and recouping from the emotional and financial stress that you have gone through and know that there's potentially some things that could be done on the back end with your tax return filings. Okay. So, when a Ponzi scheme theft loss is reported, right? From my perspective, it does potentially create significant tax planning opportunities for the current and future years. All right. We want to make sure we're maximizing these tax benefits. However, you can't maximize them if you don't know what they could be, right? If you don't know what you don't know what to ask, and you won't know what to plan for. So this is what I want this episode to change for you. What can you anticipate in the current year of discovery and in future years that you can plan for? The first is a potential net operating loss carry forward strategy. Okay, let's dive into this for a moment. The key tax benefit is if there are theft loss deductions that exceed your taxable income, they create a net operating loss. So, what does that mean? If you create a net operating loss, you've created a loss that exceeds your adjusted gross income, and it can be carried forward indefinitely to offset future taxable income. Okay, so how can this potentially be relevant to you? Well, if you have this net operating loss, you can coordinate it with future income events. And the main ones that come to mind for me and the main ones that I see with our clients are any capital gains, selling real estate at a capital gain, any any RSUs, right? Any stock, employee stock options that you have that you can exercise with your employer, that could potentially be a strategy. Any stock sales and bonuses that you can potentially plan for in the future so that you can offset your net operating loss can be a significant benefit to you. Next, if you have other sources of income, accelerating that income in the year of loss can increase immediate tax benefits. This is not for everyone because not all income can be accelerated into a year of loss or in future years. So here's where you have to 100% consult with your tax strategist, your CPA, your tax provider. And we have to monitor your AGI limitations, meaning your adjusted gross income. A large theft loss deduction may reduce or eliminate eligibility for other tax credits or deductions. So we have to make sure that we're keeping abreast of what could potentially happen, and we can start making those projections of what these net operating losses could potentially look like for you. And if you have already stacked or planned on stacking other tax strategies in future years or current year when you have a net operating loss, we have to evaluate if that's still a great strategy for you because we may need to punt it down the road. All right. So let's say a taxpayer reports $200,000 of a Ponzi scheme loss in 2024, but only has $100,000 in taxable income. The access, aka the $100,000, can offset future income indefinitely. All right. So I'm going to close the net operating loss conversation. You could always reach out with any questions you may have. I'm going to go to the next point. All right. We can sell capital gains to offset losses. Okay. This is an interesting strategy. So think about if you have a passive loss in your real estate and you end up selling your real estate asset for a capital gain, your losses will reduce your capital gains, right? And in other words, your capital gains will be reduced up to the limit of your losses, and anything left over can be carried over. So this is a very powerful strategy. And typically we look at it when someone potentially sells real estate or when someone has stock losses and they have realized capital losses that they're carrying forward, and they're potentially considering selling some stock or appreciated assets to realize a capital gain. All right, so that's typically when we come across this. However, this is also very important when we're creating a large loss during a Ponzi scheme theft loss reporting year. Okay, so how do we optimize this, right? The theft loss deduction can be used to offset taxable income, which we've already mentioned, making it a prime time to sell appreciated assets with capital gains. So here's the flip side of the net operating loss, right? In the net operating loss scenario, we want to create the largest net operating loss so we can use it for future years and then plan for the future tax strategies you may have in hand. However, with this strategy, knowing that you have a loss in the current year or potentially have net operating losses in the future years, have you considered or are you potentially considering selling appreciated assets, such as appreciated stock or real estate, in the same year as the theft loss to offset gains with the deduction, right? Or if the loss creates a net operating loss, can you sell these appreciated assets in future years and apply the carry forward against future gains, right? So consider harvesting gains and reinvesting in diversified assets to avoid concentration risk. So this is an important factor where you're going to have to bring your financial advisor into the discussion, into the mix, and your tax strategist, so you can create an appropriate tax strategy and tax planning outline so that you're maximizing your wealth, you're maximizing your assets, you're also maximizing your tax strategy. Okay. So, for example, if a taxpayer has $150,000 in taxable gains from stock sales, They can realize those gains tax-free if they have an equivalent theft loss deduction or net operating loss deduction. Are you following me? Okay, I'm assuming you are, because if you're not, you can replay the podcast to kind of gain a little bit more clarity or be dangerous enough to know the questions to ask your professionals. All right. Another really interesting strategy is a Roth conversion during loss or recovery years. Okay, not a lot of people think of this. However, when you do a Roth conversion, you're paying your taxes in the year of conversion. So if you have a whole bucket of losses, why not do a Roth conversion and consider it so that your taxable income on your Roth conversion can be offset with your losses that you just created with this Ponzi scheme loss. So, food for thought here. Okay. If that theft loss deduction significantly reduces taxable income, a Roth IRA conversion can be done at a much lower tax cost. I caution you here, you have to bring in your financial advisor into this conversation because they're going to be aware of your asset mix, where your assets are located, and what potential strategies they have for you. So, this is kind of a mutual conversation that we need to have. However, if you do proceed with this, then you can convert traditional IRA assets into a Roth IRA in the year of the loss or carry forward years when taxable income is low and maybe you have potentially created a net operating loss as well. Pay attention to the stackability components here. You can stack a lot of these together to give you a better wealth recreation scenario, a better cash flow scenario, a better tax savings scenario. So you can look at all these components one by one, or you can stack them together. If a future recovery is expected, maybe you delay conversions until the year of recovery to offset new taxable income. Just some more food for thought. And Roth conversions create tax-free growth, which can help compensate for losses suffered in the Ponzi scheme. All right. So if a taxpayer's AGI, adjusted gross income, drops to near zero due to a theft loss deduction, you can convert 100,000 plus from a traditional IRA to a Roth IRA significantly, and you're reducing your tax liability significantly there. So something to consider there. All right. Number 4, no matter what happens, no matter what tax strategies you use, or if you don't use any, we have to plan for future recoveries and clawbacks. So any recoveries from the Ponzi scheme in future years are taxable as ordinary income under the tax benefit rule. This kind of goes back to that original formula in the discovery year. When you create your deduction, you're accounting for future recoveries. And that future recovery estimate can potentially impact your actual future recoveries that you receive and will dictate whether you're going to have taxable income or whether you're going to have to restate a prior year tax return by amending it. So super, super important to keep your eye on this. All right. So how can we optimize and maximize this? 1, anticipate taxable recoveries and time your high income events and loss years to avoid an unexpected tax bill. So here I'm going to refer you back to options 1, 2, and 3, right? Time your future recoveries with some other items that you planned for in your tax strategy that we just talked about just a few moments ago. If you receive a large recovery, use tax planning strategies such as, right? Are you ready for this? Make sure you're jotting this down. Max out your pre-tax retirement contributions, right? Defer your income via 401ks, IRAs, self-employment plans, etc., cash balance plans, profit shares, whatever's available to you and whatever you can reasonably come up with and coordinate with your financial advisor, with your tax strategist, with your CPA. Accelerate deductible expenses. Obviously, consult with your tax professional. On your personal tax return, Do you have some medical tax expenses that you can itemize or charitable donations, right? Do you have more real estate where you can deduct real estate taxes, although watch the SALT cap there? What other things can you accelerate into the year where you're going to have a higher recovery? On your business tax return, right? Defer your business income when possible. It's not always possible to do this, so take this comment with a grain of salt. You have to consult your tax professional to make sure you're following and complying with all the IRS rules, right? So defer business income to years when the recovery won't spike taxable income, right? Estimate your clawbacks. Okay. If previous Ponzi scheme withdrawals must be returned, taxpayer must be able to amend prior year returns to recover taxes paid on those withdrawals. This can create significant items for you to consider. Going back to talking about businesses, maximize your business expenses. So when I talk about stacking tax strategies, stack them on the individual level, stack them on the business level where possible, where legally possible, where you're able to do so, and you can justify that it's a legitimate business expense. All right. All right. So let's say a taxpayer expects a 50,000 of recovery in the next year. You can plan for a Roth conversion or sell capital assets at a loss to offset it. All right. So let's make sure that you're looking at these things to make sure you're maximizing your results here. All right. We talked about employee stock options before, right? So exercising your RSUs and ESOs and NSOs and whatever acronyms you want to make them, but essentially you want to look at these during loss or recovery years. Okay. So when your employer gives you the ability to have NSOs, RSUs, or ESOs, they create a taxable event when exercised. So if structured correctly, you can offset the theft loss deduction or any NOL carryovers if you're able to speak to your employer and take those exercised options in the year of the loss or a year of future NOL carryforwards. Okay. So if you exercise RSUs or ESOs in the year of the theft loss to reduce your taxable impact, that can be a great strategy for you, right? Maybe you won't get any money back, but then you've already converted future taxable events, meaning conversions over your RSUs or ESOs in the year of loss recovery. So you're planning ahead. You'll be paying less taxes in the future. If you're using an NOL carry forward, time the exercises to match available tax deductions in future years. It's kind of obvious, but I needed to state that again. And consider using non-qualified stock options strategically, since they create ordinary income upon exercise, right? Which can be offset by NOL. So there's lots of options for you. So say for example, you have $200,000 invested RSUs and you have the option to exercise in the year of the loss and you owe no tax due to the Ponzi scheme deduction, right? You can offset that loss with your RSU conversion, and you can significantly limit, if not lower, or potentially even reduce entirely to zero your tax liability for that tax year. So super important to consider, especially if we have employees in that situation. Another thing to consider is charitable giving strategies, right? If a taxpayer experiences large taxable recoveries, charitable giving can help reduce income, right? You can donate to your favorite charity as you itemize your tax returns on your Schedule A. Okay. You can look into donor advised funds and control which charities you want to be able to donate to. Okay. You can donate appreciated securities. And you can also consider charitable LLC multipliers. So there's a lot of things to consider here. So I want to make sure you have the tools to be able to create your recipe for the success that you're looking for in this recovery process. Another thing that people typically don't talk about, and it's kind of obvious where it's a little silly, but I'm going to mention it anyways. adjust your estimated tax payments and your withholdings on your W 2 wages, right? Your theft loss deductions often reduce your taxable income significantly, meaning less tax is owed. So, if less tax is owed, by default, you should be adjusting your estimated tax payments if you're required to pay any, and you should be talking to your employer to reduce your federal and or state withholdings. Okay? So reduce estimated tax payments, adjust your W-4 withholdings with your employer. And these two things alone will immediately improve your cash flow. All right? Plan for higher future years of recoveries and adjust withholding accordingly as well. This requires some tax planning. All right? And if you're expecting a large refund due to the loss, consider adjusting withholdings before year end. Or maybe you won't have to pay your extension payment. Whatever that combination is for you, make sure you're considering that in the mix of your decision making. All right? Review your state tax treatments. Some states don't do exactly how the IRS performs the safe harbor rules for Ponzi losses. So make sure you're looking at your specific state rules, right? And then consider alternative tax reduction strategies if you have any. All right. I really, really, really hope this helped. And the main key takeaways are even though you're maybe thinking about, so well, one, probably going through an emotional, oh my gosh, roller coaster. I can't even imagine because you've lost so much money. However, if we plan ahead, we're not only trying to have you consider recouping those losses with IRS's safe harbor rules, but also consider the current and potential tax strategies you can utilize to get you into an even better tax situation, a better cash flow situation, and hopefully recover some of that nest egg you've been curating over the last several years and potentially lost income there. So I hope this helped. I really, really enjoy talking about these strategies. And if you have any questions, please feel free to reach out. Nothing's a bad question. And I hope you're enjoying these videos. And if you are, please share them with someone that may need them. Please comment, like, and subscribe. And we'll see you next time. Bye.